Without a doubt, he is highly sought after when it comes to analyzing and offering expert opinion on government budgets and economic policies. He has served in various capacities at the Nigerian Economic Summit Group since 1999. He has served as rapporteur and consultant to the Trade and Investment Policy Commission, and indeed, he has won several awards in the past. As a testament of his hard work, excellence, and diligence, he has won multiple awards, including the Henry Fajemirokun Award for Best Graduating Student in Business Economics in 1980. Please welcome Dr. Biodun Adedipe. Our second speaker is Ms. Chinwe Egrim, Senior Economist at the FBN Quest Merchant Bank. She's highly sought after and also has spoken at many prestigious economic conferences inside and outside Nigeria. Chinwe has over 500 published economic notes, primarily geared towards macroeconomic fiscal profiles, monetary policies, FX dynamics, GDP growth trends, inflation, and several trends. Chinwe's contribution has also supported high-level committees set up by the development agencies like the World Bank. In 2017, she was included in the World Bank's Systemic Country Diagnostic Consultative Committee, where she provided relevant market-driven insights. Please welcome Chinwe Egrim. Our moderator this afternoon is Mr. Bola Onodele Koko. He is a graduate of economics from the University of Ibadan, a chartered accountant who won the Icon Prize for the best overall performance in 1989. Koko has over 25 years financial services experience, including involvement in financial markets architecture and diplomacy. He has midwifed a good number of financial market infrastructural development initiatives in Nigeria, an extremely deep economist and a first-class banker. He has served across various companies and organizations, some of which include PricewaterhouseCoopers, FCMB, Citibank Nigeria, Trust Bank of Africa Merchant Bankers, Lead Bank PLC, and as president of FDHL, a financial markets and risk market consulting firm he founded in 2001. Mr. Bola Onodele is currently the Chief Executive Officer of FMDQ OTC Securities Exchange, FMDQ OTC Securities Exchange. I have no doubt in my mind that we have some of Nigerians' best on the call this afternoon. Permit me to hand over the proceedings of the webinar to our moderator, Mr. Bola Onodele Koko. Once again, I welcome everyone to today's event. Thank you very much for joining us.
Thank you very much, Mr. Shuntoki, and good afternoon, distinguished ladies and gentlemen. I'm very pleased to be here this afternoon. When the invitation came through my friend, Akin Oshuntoki, who I consider a fine and refined capitalist, I reckon that most of the members of the Chamber of Commerce will be of his ilk. And I thought it would be good for us to discuss the Nigerian economy, which I'm also pleased that we have Dr. Adedipe and Chinwe here to do justice to the Nigerian economy. I have only 10 minutes to speak ahead of them moderating from this point. And the topic is interesting, looking at the Nigerian economy. So what I've done is to just cut about 4 slides or 5 for us to go through in this 10 minutes my own take, my perspective on the Nigerian economy. So if we could roll to the next slide, the conversation is going to cover 3 main areas. We'll look at the scorecard, which is what we've seen of the Nigerian economy in the last 60 or 50 years. Do a bit of benchmarking. It's always good to compare yourself with others because an economy is not very different from a company, as we'll see very soon. And the last piece of it is the hope for prosperity in our own time. Be that as it may, when we look at the macro, looking at the economy from this point, you see that indeed the Nigerian economy has really gotten much bigger, but we shouldn't look at macro alone when we look at an economy. We have to look at the social side of it. So that is the socio-economic part. The benchmarking, we're using Brazil, and very soon I'll tell you why we've decided to pick Brazil. And that prosperity is where we think Nigeria should be, deserves to be, and to see how much work we need to do that. So we can move to the next slide. Pretty much in real terms, if you ask me, I don't think this is a very high score. Interestingly, 50 years ago, inflation was 13.76 in Nigeria. We have it at 14% today. You see the ring on unemployment rate. If you believe the figure on that unemployment rate, then you think it's 27. Even 27 is not good. But I think, it could be, my guess is could be higher than 27 from what we see. An interesting row there is row 6, which is the exchange rate. Again, depends on who you're speaking with. If you're speaking to the bankers, they may tell you the exchange rate is 380. If you're speaking to people on the street, they may tell you the exchange rate is 480 going towards 500. But I'm not going to spend too much time on the economy scorecard because Dr. Adedipe is here and you listen to his resume. And I'm sure you didn't hear from Akin that I won the prize on economics or anything. So I'll go to the social scorecard, which to me is really the pulse of the economy. All those numbers about GDP and things like that are great, inflation, interest rate. But what matters to me, quite honestly, and should matter to all of us, is the prosperity of our people. And if you see this chart, and if this were your subjects when you were in Form 4, and you have 12 subjects, and you have, about 7 green, which means you did very well, and 5 red, then you could say you didn't do badly as an average student. But it's important for us to identify the major pillars in any economy. And I think those 2 pillars for me will be education and healthcare. Look, these numbers are from the World Bank and things like that. If you talk about access to healthcare in Nigeria, maybe it has increased, but I really do challenge the quality of healthcare. So that healthcare for me is not going to be a green. If you look at education overall in Nigeria, and we know that the primary and the secondary education, those standards could have gone up. And I think the reason why they've gone up in Nigeria is probably the private sector. The tertiary education, the standards we all know in Nigeria, the standards have dropped. And if you look at healthcare, those two pillars and education, and they're not success stories, then you start imagining what the future holds for Nigeria. In terms of security, I think that is a red. Population is great, depending on what you do with it, but moving from, in 10 years, 122 to 200 means there can be a market here, but you want to make sure that that market is effective. Number of telephones, the number has risen. Thank God for GSM. In the past, up to GSM, I think we have just 400,000 lines in Nigeria, of which they weren't working every day. Property rights, fiscal sustainability are challenged. GDP per capita continues to head south, which is not good. But if you look at the pension system in the country, we've moved from defined to a scheme to contributory schemes. And I think that could be a plus. The issue and the main question to consider in Nigeria today is where are the assets of the pension being invested? So we decided we should look at benchmarking, and a country came to mind. And that country, Nigeria, has played football with that country so many times. The football of that country excites Nigerians. And we narrowed down to Brazil for so many reasons. The population size, then 200 million as well. In the past, it's had very high inflation, which has gone to 3 digits at times. Transportation, the major transportation, the mode of transportation used to be road. As at 2004, it had about 500 kilometers of rail. But you know what? In 3 years, 2004 to 2007, that country added over 32,000 kilometers of rail. It used to be a mono export economy like Nigeria, and the poverty rate previously very high. So what does that benchmark bring? The next slide shows you what you see between Nigeria and Brazil. I've spoken to the road network. We can look at the people with income below $1 a day. Nigeria has about 82 million people. Brazil's figure is not that high, but we use $2, which is what we could see, and it's even 9 million. If we did $2, Nigerians' figure will be much higher. The GDP per capita, we're like, Brazil is 5 times Nigeria. Education, Brazil is doing much better in terms of ranking. Prosperity index, out of 167, Nigeria is 144. If you look at the equity market cap, Nigeria is $44 billion, whereas Brazil is in trillions. The debt side is the same story. Nigeria is 70, and Brazil is almost $1 trillion. So if we have 200 million people and Brazil has 200 million people, those are the resources God has given us. What have we done with 200 million people in Nigeria? That is what we've done with it. But you know what? We shouldn't despair. There's hope. Next slide, please, so I can round up before handing over to Dr. Adedipe. We shouldn't despair because Nigeria, to me, is a diamond in the rough. And if we can get our acts together, Nigeria can be very great, I would say again. So what do we need? We need a codified economic transformation agenda in Nigeria. And to have that, it starts with leadership. So there are 4 boxes there, and I'm going to just speak to 3-4 items in the 2 minutes I have to go. The fish rots from the head. If we don't get leadership right, we will not be able to drive the economic and social transformation that we need in Nigeria, which requires planning, it requires visioning of the highest quality. Earlier, when Mr. Oshintoki spoke, he spoke about the talent in Nigeria. Nigeria is not short of talent, but leadership is going to be very key because we need economic transformation that will be underpinned by an articulated philosophy. In having this economic transformation, visioning will be important. Fiscal restructuring, rule of law is going to be important. The social side, for me, is very key. Security of food, life, and property. Social security has to come. We've seen NSAS and the aftermath and all the attendant issues that came with it. We cannot continue to ignore these areas. I think there's need for housing revolution in Nigeria. Population management is very controversial, but we just have to look at the politics of it and what to do with it in Nigeria. In terms of economic, agriculture is major. We need to improve on our manufacturing base, infrastructure, broadband, for example, today is very key in any economy. Consumer credit, we need to look at that because, if you have that manufacturing sector, you need to ensure the consumer credit is in place. We look at markets. I think once we have a philosophy, we know what to do with financial markets. We cannot deregulate some aspects and keep regulation on others. We just need to codify what we want to do. The last point I'm going to make on that market, we need to ensure access for private companies. They need to have access to debt capital. And I think that is one thing that has been denied private companies, and we need to do it. So on the last note, Nigeria to me indeed is a diamond in the rough. It is doable. It is great. Thank you very much for listening to me as we set the tone for the speakers, the two speakers that we're going to take on. Dr. Adedipe will come first, and I think he will do justice as usual to the Nigerian economy, the review of it and forecast. Thank you. Dr. Adedipe.
Thank you so very much, Coco. Essentially, Coco has done a very good job of what I was supposed to do. But what essentially I will do right now is to dive deeper into some aspects of what he mentioned, a fantastic preview of the conversation this afternoon. So I will share my slides and go through that quickly in presenting my own message about the Nigerian economy in the year 2020 and what we look forward to seeing in 2021 and possibly beyond. So my starting point here is to remind us how the year started. At the beginning of 2020, we all started with the promise of a new decade of lofty expectations about the national economy and of course the global economy. We had conversations around dynamics of technologies, migrations, climate change, inequality, etc. And I remember remarking at a discourse on the economics of the decade. That was the conversation then, economics of the decade in January this year. And I made the remark that jobs and wealth creation are central to the new economy. And the right education is equally fundamental to these two critical issues. Now, a couple of weeks after that, COVID came and people began to run for their lives. So around the world, governments, corporate entities, individuals, households began to think about how do we make a balanced choice between life, and that is surviving COVID-19, and death, quick and result from what we had no clue what it meant at the time, And of course, the economy, which itself can also come to trouble if this issue is not properly handled. So my interpretation of it all, up until today now, is that when everything is no longer what it used to be, then it is time for us to rethink everything. That means it is not about rethinking an aspect. I will notice that in the submission by Coco shortly, okay? I mean, a short while ago, that we have to look at practically everything and redraw whatever we intend to do. And I chose to put this also in context, what I describe as the pre-existing vulnerable conditions of developing economies. Of course, Nigeria falls within that category. And I decided here to highlight 6 things. Now, incidentally, you find that these issues are also cross-cutting in what the moderator shared with us earlier on. Now, the first thing to draw attention to is the fact that most vulnerable developing economies like Nigeria are resource dependent. Now, being resource dependent is only from one side to it, which you can readily relate to with Nigeria. That Nigeria depends significantly on hydrocarbons, and that talks about crude oil, condensate, and associated gas, accounting for about 87% of our foreign earnings. And of course, look also at our dependence on foreign capital inflows, and that is looking at the finance leg of the interaction with the rest of the world. Up to 67% of that happen to be portfolio investments, but currently, based on the latest data available, about 52%. We then move over to East Asia and take another example from there, Bangladesh. Now, Bangladesh depends on garments export up to the tune of about 84% of its foreign earnings. So that paints the picture of resource dependence, but for Nigeria, it's even worse. And why do I say it is worse? Worse because hydrocarbons by their nature are a wasting asset, and they are not renewable. Okay, secondly, most of them are highly indebted. Of course, when they also borrow, oftentimes the borrowed funds are misused, which then makes servicing and repayment become a constraint or resources for development. Thirdly, they have very large informal sectors. In fact, if you look at the gross domestic product and you pair that, you find that the large informal sectors dominate the GDP and also economic activities. And we see how this comes together in the context of what 2020 represents to every country around the world. Now, for MSME, that is micro, small, and medium scale enterprises, if you take a head count, they represent also a large proportion of their GDP, and at the same time, a large proportion in terms of head count of their manufacturing activities. In Nigeria, over 90% of manufacturing entities are SMEs. That's by head count. So, and of course, look at GDP also, look at the number in terms of proportion, equally dominated by MSMEs. Then comes the issue of population. You recollect earlier that Coco mentioned, used Brazil as a benchmark. Now, if you look at the large population, ordinarily we say it's a body. But the lesson we also took away from China in recent decades is the fact that it is not how large the population is that is the problem, it is how actively engaged they are. So now we talk about where we end my conversation on the economy. Then there's high poverty incidence, which is simply to say a large number of their people live below the poverty line. So what was the magic that China, for example, used to bring within the space of their economic reconnaissance of over 10 to 20 years, about 23.1% of their population from below to above the poverty line? So these are things we relate to as we look at some data. I love data, and the reason is very simple. Data doesn't deceive except to misinterpret it. But if you interpret data in, what I will call a professional way and not a dubious way, then you can really see what the data is telling you and then respond appropriately. Now, this is the last chart I got out of the macroeconomic data on Nigeria in terms of the misery index. What this index tells you is how miserable people living within that economic space are. And there are 4 elements that define the misery index. Number 1 is your rate of inflation. Then you have also your rate of interest, and then you have also the rate of unemployment. Add up those 3 rates, and then subtract from the addition the growth rate of your GDP. Whatever you get is the misery index, which means if you can't grow your economy faster than the rates of unemployment, rate of interest, and rate of inflation, then people become miserable. But of course, if these 3 rates vis-a-vis GDP are lower, then the miserable level of people will be dampened. So that gives us a picture of where we are today. In fact, what I did there in that chart is from 2015 till date. That is up until the latest data available on unemployment. Now, this is a global phenomenon. The dimension to COVID-19 disruptions, volatility, uncertainty, complexity, ambiguity. Every one of us have been talking about that since the beginning of this year, especially since March 2020. But what has that meant for us in terms of economic management? Now, let me say this here, because I decided not to put a slide in here. There are 4 types of crises that all over the world, governments, economies, households are battling with. The first is the health crisis caused by COVID-19 as the starting point. Now, the response to that resulted in economic crisis, because as we begin to lock down economics in response to that, then businesses, households begin to suffer. Now, if that is not addressed properly, it will become a humanitarian crisis, which we have seen all over the world. If you don't also address humanitarian crisis properly, it will become a security crisis. So you are looking at a situation where we went from a complicated health challenge to complex situation of health, economics, humanitarian, and then security challenges, and then you come to chaos. And we say that once we get to that, welcome to the new normal. So with our conversation, like the moderator said earlier on, is how do we get ready for the next normal? Which means the conversation today is not about the new normal. We're already in it since March this year, but what about the next normal? Now, I use this slide to summarize the economic challenges and implications of what we have seen this year. Now, VUCA disruptions cause different kind of problems in different countries. For some, it was demand shock. For some, it was supply shock. For some, it was inflation shock. For some, it was deflation shock. But primarily, we saw total supply chains radically collapsed or partially, and of course, sectors collapsed: hospitality, tourism, aviation, luxury goods, etc. Businesses, job losses, diminished capacity to meet maturing obligations. And also a phenomenon that started this year about May and June, and that is a seeming reversal of globalization. And we saw that happen in policies of governments in Japan, in the USA, in UAE, and a couple of other countries around the world. So we expect, therefore, that this year, the global economy will end up with a recession. And that is, as predicted by IMF in its October 2020 outlook, 4.4% shrinking. So if this happens all around the world, what do we expect? So that brings us back home to Nigeria. What does our economy look like at the present moment? Now, by Monday, 23rd of November, we expect to get the GDP data for the 3rd quarter of this year. When we get that, one thing we are sure of is that it will confirm that our economy is in recession, okay? So, but this is what the economy looks like if you consider a snapshot of it as at the end of June 2020. So we see there agri dominating contribution to GDP at 24.7. We have mining and quarrying 9.1, manufacturing 8.8. We come down to trade 14.3. Then we see ICT 17.8 and real estate 5.3. Why those 6 sectors? Those 6 sectors in the last 10 years have consistently accounted for between 77 and 82% of contribution to GDP. So they are very key in terms of contribution to GDP. We can then relate them also to jobs anyway, because that is a major issue for us in managing the economy. But one interesting thing, was the flip, that is a shift in this contribution. For the first time in the last 10 years, ICT contributed more than trade in the second quarter of 2020. That never happened in the last 10 years, but it happened between April and June this year, when ICT overtook trade to become the number 2 contributor to GDP in Nigeria. We put that on one side. I will return to that when we are concluding. Now, I will skip this slide because I've made some reference to that already, and come to this very important one. This gives us the trajectory of the Nigerian economy. We see the rate of growth of the GDP, which I peaked only between first quarter of 2013 and second quarter of 2020. But if you look at that straight line there, we call it the trend line, which means if we look at the growth rate we have had in the last 7 years, thereabout, going to 8 years now, clearly the Nigerian economy has been slowing down. That's what the trend line shows. It's been slowing down. But clearly also, as I remarked earlier, that by now we know that the economy entered recession by end of September. So that means October to December this year is critical in terms of what the government does, because they still have some window to do something before now and the end of the year. But if we go by the projections by the National Bureau of Statistics, the Nigerian economy is expected to dampen by 4.2% this year, but grow by 3% in 2021. That is looking forward. So now that expected growth in 2021, interestingly, is going to exceed the growth rate of our population, which currently is at 2.58%. There's a bit of improvement there in a way, because some 10 years back, our population was growing at 3.2%. About 5 years ago, it was growing at 2.8%. But the latest data put out by the NBS shows that, and also United Nations, that is growing by 2.58% per annum. So if the economic grows by 3% in 2021, again, that will be a new experience in the sense that looking at the data in the last 20 years, maybe I can even shorten it to the last 10 years so that we don't think too far back, all right? The growth rate of our GDP has been most of the time below the growth rate of our population. So if this happens, that would bring a new story, in which case it represents a good prospect for discerning investors. Now, coming to this issue of exports and export, that is, whether we are export-driven or import-driven. Historically, and I remember being a part of a conversation in London way back 16 years ago. I was invited by ODI to do a presentation that will look at the Nigerian economy since independence 1960 up to 2004 then, and then take a position whether the oil sector and what it has been doing to us has been the major driver of our economic policy. Now, if I look at that situation 16 years ago, when I made that presentation in London, and as of today, there has been no shift, in which case Nigeria remains dependent on hydrocarbons, and that had likely determined the direction of our economic policy. So when something happened second quarter of this year, and this again is usually something we tie to either recession or economic crisis somewhat. So in which case the recession we are talking about for in 2020 had been presaged by what happened in the nexus between imports and exports in Nigeria. The second quarter of this year, our imports became greater than exports, in which case we imported more than we exported. So the question then is, what were those things we were importing? And if you see the data, what it shows you is that consistently in the last 7 years, the average monthly import bill of Nigeria has been going up. The latest figure we had is about $1.3 billion per month in terms of import bill. So the question is, what are we importing? And that brings us also to the issue of tinkering with government policy in order to create the kind of environment that will result in job and wealth creation. I will come to that shortly when I want to conclude. Equally, if you look at manufacturing, that's the real sector, it's been impacted by COVID-19, but that sector seems to be recovering. And why do I say that? Again, using as a reference the Purchasing Managers Index that the Central Bank of Nigeria computes and generates on a monthly basis. That index from June 2015 till date, and that is up until the November 2020 report, shows that there was a dampening from June this year, okay, when it got to the lowest point of 41.1 points. At 41.1 points, that is below 50 points, it means manufacturing is shrinking. Anytime it's below 50, it is shrinking. But above 50 means manufacturing is expanding. So we only returned to above 50 this month, November 2020. So, and my take on this is that this sector holds the key to both wealth and job creation, because it is simply a matter of volume and margin. But in an economy where we depend so much on everything produced in other countries, what we keep on doing, therefore, is creating jobs offshore and not creating jobs locally, in which case emphasis is more on the finance leg of the external sector of the economy rather than on the production leg. I will conclude with that shortly in another few minutes. I've already talked about our monthly import bill. You can see the table to the right of this slide. And of course, you can see the trend with our external reserves. The critical thing here is whether the external reserves can extinguish our foreign obligations. So usually what we do is we consider the primary thing there, which is our monthly import bill, and compare that with our external reserves, and then ask how many months of our import bill can the reserves pay. In economic theory, ideally, we say that your monthly import bill should be covered not less than 6 times by your external reserves. The latest check I made showed 9.34 months. But of course, there are still some other things you need to consider here, and that is obligations that are not captured in terms of import. That is the finance leg that I mentioned earlier on. Now, if you add those to the import bill, clearly these external reserves will be looking anything below 6 months coverage, in which case it is a time for us to return to the drawing board and review everything. Now, in talking about the exchange value of the Naira, we've seen the valuation twice this year, all right? That's in the official market. But like Coco said earlier on, if you also, it depends on which segment of the market you are looking at. But the segment you look at also will tell you what the rate is. So but the critical thing here is if we take the official rate and look at alternative markets, in fact, we usually say that the roadside market. So if I want to buy a foreign currency at the roadside, how much in terms of Naira will I have to put out in exchange for $1 or £1 sterling? So that will determine what we call the premium. Once that premium is greater than 5%, every manager of an economy will become worried. But as we are today, we are far, far above 5%, so it should be worrisome, okay? Now, this is the final chart I will show, and then speak to a few things, and then we can go on and discuss a lot more. Now, capital importation is the finance leg. The idea simply is this: if you don't produce enough locally to sell to the rest of the world, it then means you will have obligations that are greater than what you produce locally, and so that gap needs to be filled, and that is where capital importation comes in, either in the form of foreign direct investment or in the form of investments in your diverse financial markets, all right? And of course, the other leg to that is government borrowing. The government has to now borrow offshore, but you need to bridge that finance gap. Now, in bridging that gap, is either you create an environment conducive for investors to come into Nigeria, and that talks to policies, or alternatively, you consider the fact that the economy has such attractive indices and parameters that inspire confidence in anyone to make a decision to choose Nigeria over others. Remember, when Coco said it earlier on, it's one of my favorite ways of looking at economics, and that is you are in competition. And this competition, ladies and gentlemen, in a simple, basic manner is zero sum. An investor wants to come to Africa. He has a choice between Nigeria and 50-something other African countries. So if he has to choose Nigeria, that means Nigeria must show some form of attraction and therefore be competitive internationally for him to choose to bring his money to Nigeria. And that is the reality of it. So how do we become more attractive to those investors? Even those that want to lend money, how do we become attractive to them? So that brings me to this. I won't need to talk about this. The only reason I brought this here is to show that the stock market generally is a leading economic indicator. So when your stock market is slowing down, then you should expect that the economy will likely follow very soon. And if the economy is going to pick up, take a look at what is happening in the stock market. Now, this is the government's plan for next year. They are still discussing this anyway. So, because as we speak today, some variables in this have changed, as it were. All right? They are still discussing it. But for me, as a professional economist, I'm still waiting and looking forward to that time in future when Nigeria as a nation will shift away from reference to crude oil production and its price in designing our national budget. I served as a part of a presidential committee 10 years ago when we looked at this issue. And we said the best example we could refer to is Netherlands. They have also been in the situation Nigeria is currently. So we ask ourselves, if in economic theory we talk about the Dutch disease, that means the Dutch, at the point in time in their history, dependent on hydrocarbons, and then we said, how did they get out of that problem? And it's a very, yes, simple, but difficult to execute without a political will. Simple in the sense that there are 4 variables in your fiscal operations as a government. One is you generate revenue, and that falls into parts. Oil revenue, non-oil revenue. Equally, you spend. That falls again into parts. Capital and recurrent. So, and the way the Dutch got out of the trouble Nigeria is in today, and that is what we advised the government 10 years ago. The way they went about it was to say, look, let us design a policy framework that will enable us in a defined period of time to equate non-oil revenue with recurrent expenditure. In that way, we free oil revenue for only capital expenditure. That is either for investing in economic and social infrastructure and whatever that is in terms of capital. So now, that's why I'm not going deep into the budget, okay? I just did here a summary for those who have not had time to look at it. So now, what is the outlook for year 2021 going forward? Taking this year 2020 as a base, where do we expect the year to end? Okay, like I reminded earlier on, the MBS projected that the economy will end at minus 4.2% dampening. That's in our GDP, okay? But in the Ministry of Finance and Budget and National Planning, what are their expectations between now and 2023? They expect GDP to grow by 3% next year. That, of course, they took from MBS. Then to grow by 4.6% in 2022, 3.86% in 2023. So what we simply did in our company was to say, okay, if Nigeria can maintain that trajectory, then we see in 2024 and 2025 that the economy can grow further. But that also rides on the back of the continuing renewal of infrastructure. Remember in the benchmark that Coco gave us earlier on between Brazil and Nigeria. I was also a part of similar conversation in 2008 when we said, let's take a look at what China did to infrastructure. And it was very simple. Nigeria in terms of land mass is 10% of China. So what I advised President Yar'Adua's government then was that, look, let's do 10% of what China did in terms of infrastructure, and we be as effective and efficient as a manufacturing ground for the world, like China was in 2008. I was a part of similar conversation way back in 1990 March in Paris, where we talked about how will Africa become the manufacturing base for the rest of the world. Now, that was a conversation over 30 years ago, all right? Now, we had a few other things projected here. How will our population grow? And of course, we use UN data as basis for that projection. And also part of what we did when we did the business plan for the current national ID card project. Okay, we projected the population of Nigeria up to year 2050 when we did that for the National Identity Management Commission in 2008. So all of these play out in what we have here. So what this shows clearly in coming to conclusion. I took this from a publication that was released by McKinsey just this month, about 2 weeks ago. And this came from the executive summary of that publication. Economic recovery, and this is what is happening all around the world post-COVID, as economies began to reopen. Recovery is sustained by three things: manufacturing, trade, and the consumer sector. Public health has been restored in China, while European countries impose new restrictions amid rising COVID-19 levels. Okay, happily for us in Nigeria, COVID-19 has not gone in the direction of a rampage. And so that gives us some measure of advantage in dealing with humanitarian issues and also dealing with economic issues. So it's a time for us to get it right. And that is where I will end my presentation. I've repeatedly put this before our government. You cannot bring economic emancipation in Nigeria if we keep investing and creating policies that are not focused. We have no top priority in terms of sectors. I've looked at economies all around the world, and most advanced economies and emerging economies have a peculiar attribute to them. And that's the fact that they have either a top sector or maybe top three priority sectors that everything they do is channeled towards. In terms of investment in infrastructure, education, ICT, just name it. Everything is directed towards strengthening that sector. So until we get to that point where we focus on some top priority sectors, things might not change significantly. And that means putting more resources to them and also having the appropriate policies to drive growth and also jobs in those sectors. Local manufacturing for me is key to wealth creation and job creation. And this is a dimension also I've covered over the years. The government should not, of top functionaries, should not sit back in their offices and wait for private sector operators to come to them. Rather, they should go out and market those private sector entities that have capacity to drive growth in the selected sectors and also the delivery of key infrastructure. In which case, we will have to reverse the practice of someone sitting in the chair in the office waiting for the OPS, that's the organized private sector, to come crawling and beg them to change the policy or whatever. Rather, they should go out and inquire. Now, I served for a short period, just 3 months window, in the government in 2011 as a senior economic advisor to the president. And I remember what we triggered then was that we should go after PAN, we should go after Vox, we should go after Dunlop, and all of these entities that were known to be actively involved in the situation way back then in 1980 and the early 80s, when most popular vehicles in Nigeria had 70% local content. And we said, what can we do? That effort is what retained Innocence Motors in Nigeria today. Nigeria would have lost Innocence to Ghana 9 years ago. Okay? But what we did then in my 3 months in government was to go to Nnewi to tell him to do. And we now told him, look, you don't need to go to Ghana. What you need is support. In what manner? I said, well, low interest rate. He said, sorry, we can't influence interest rate. He said, okay, how about government patronage? He said, exactly. We can influence government patronage. The government will buy your vehicles in Nigeria, and we ensure the then president signed a memo to all the MDAs for that purpose. That's the kind of thing that I'm advocating here. Government should go out after major players in the organized private sector and ask them what do they need in order to remain in operation, to employ more people, to produce more, and therefore help to reduce the export-import imbalance. The government also deliberately must invest in public educational and health institutions, like Coco said earlier on. And that is why I conclude on the same note with Coco that 2021 is actually more promising. Thank you, ladies and gentlemen. God bless you all.
Thank you. Thank you, Dr. Adipe, for your exciting presentation. You covered a lot in the 20 minutes allocated. You took more, but I was enjoying it, and I'm sure all the audience was also enjoying you. You covered The misery index is one that a lot of people will start using in Lagos now and wherever they're listening. Inflation, unemployment rate, interest rate divided by GDP. You also spoke to the role of, leadership in a way, indirectly on how you handle the health crisis. It translates to economic crisis, humanitarian and security. I think for us, we may just have jumped from health to security, probably because of inherent weaknesses in our business. You also touched on jobs. I cannot overemphasize that. We need to create opportunities for jobs, and it's not going to come from government agencies. I enjoy the brilliant, position you took on how it's really government that should be wooing the private sector at the moment and giving them some of the policies required. So one of those things that we've been given is the KAMA 2020. I hope they will do a lot more in creating the enabling environment that we require. You also spoke to the foreign exchange system, and I agree with you that interest rate has a big role to play. I enjoyed your analysis of the external sector and also looking at our reserves. Well, if we stop funding trade and other things from the reserves and create opportunities for the private sector itself to fund trade, then maybe we'll see growth in our reserves rather than us using reserves to fund some of these things. I enjoyed the way you landed your presentation. Always a pleasure listening to you. And I was a bit envious of your occupation, hearing about London, Paris, and all those places. But when I finished first degree in economics, I thought I wasn't going to do PhD, pursue things like that. But a bit of regret now. On a more serious note, you spoke to picking 3 priority sectors, and I agree with you. If one administration takes 3 sectors and will do a lot and fix, the next administration will come, hopefully identify other sectors, keep on building on the ones the previous administration delivered, and then open new vista for economic transformation. I'm pleased to hear that you've been part of government in the past, although it was short-lived. I wish that had lasted for long. We need people like you in government, especially the fiscal side, to sort of let them appreciate the fact that it is not about control. It is about that prosperity for Nigeria and from Nigerians. I agree, and I'm sure a lot of our listeners, the audience would have agreed on what you said about manufacturing and infrastructure. And then you concluded with those 2 pillars again, education and health, healthcare, because that is where you have the people, the investment tomorrow to become the leaders, engineers, and so many in this great nation of ours. Thank you very much for a wonderful presentation. And there are a lot of questions that I'm sure will be waiting for you. And as the moderator, the questions that are for me, I will pass to you and Chinwe. I won't be the one taking questions. I'm going to invite Chinwe Igwem to speak. Chinwe, as introduced, is also a senior economist in one of the leading merchant banks in the country. And she will speak for 10 minutes, after which we'll take a break and then we'll come for Q&A, which will last for about 25 minutes. And we've got some questions already. So Chinwe, over to you for the next 10 minutes.
Thank you so much for that. I'm going to have to apologize. I can't put on my video because of internet connectivity. So yeah, so many thanks for having me. I will provide a snapshot of the economy from a review perspective, and then I will share projections for specific core economic indicators. And hopefully I am able to fit everything into 10 minutes. I'll try my best. Okay, so I'll just kick off with GDP growth. Dr. Adedipe has covered some of that, so I would try to speed this up. So yeah, so the economy kicked off the first quarter with a growth of 1.9% year on year. And March brought with it the early visible signs of the impact of the ongoing pandemic. Q2 posted a contraction of, I think, minus 6.1% year on year. And the oil economy contracted by minus 6.6%. And This is compared with a growth of 5.1% in the previous quarter. As for the non-oil economy, it contracted by minus 6.1%, compared with a growth of 1.6%. Now, oil's formal share of real GDP amounted to just 8.9% in Q2. And this makes it the fourth largest sector in the economy. That's after agriculture, information and communications, and then trade. However, through its linkages across other sectors, the indirect oil economy may be at least 40% of GDP. Most sectors shrank due to the selective lockdown designed to combat the COVID-19 pandemic. The major hits to the oil price, and to a lesser extent, the deterioration in external demand. Now, looking ahead to Q3 2020, we're expecting the national accounts this month. We project a GDP contraction of about, let's say, minus 5%, which is not as steep as what we saw in Q2. Agriculture should fare a little better due to the harvest season. However, the oil and gas sector will perform a bit worse than it did in the previous sector. And of course, the non-agric, non-oil economy should benefit a bit from the easing of restrictions that we saw. I'm going to go into what I call the Purchasing Managers Index, FBN Quest Purchasing Managers Index. Now, our latest headline Purchasing Managers Index reading declined from 54.8 to 51.3 in October. A PMI checks the temperature of the manufacturing industry. I just thought I needed to say that for those who don't know. All of the 5 sub-indices recorded decreases, largely attributed to the social unrest, which erupted across different states in the country in the middle of October. This resulted in the reintroduction of curfews, which in turn affected production. Now, demand also weakened due to the associated economic hardship. However, we note that prior to the recent disruption to consumption patterns due to COVID-19, and going back to Nigeria's last recession, consumer pockets had been squeezed and were yet to be rebuilt. There were also supply-side constraints as accessing raw materials and production inputs were difficult during the month. This year, the PMI has recorded negative readings at least twice. So a negative reading is when the PMI goes below 50. And that has happened at least twice this year. So I'm going to walk into inflation. From June 2018 through to September 2019, the headline rates settled in a range of between 11 to 11.5% year on year. However, the rate has since taken an upward direction following the closure of land borders, which happened in the middle of August last year. The steady increase to 14.23% in October 2020 has been largely driven by food prices before and during COVID-19. So the October inflation report, which was released on Monday, shows the 14th successive uptick in the year-on-year headline rate. This year, the highest month-on-month increase in the headline measure has been 51 basis points in October, while September, August, and July registered increases of 47 basis points, 41 basis points, and 26 basis points, respectively. Food inflation has been the primary driver of this acceleration. Supply-side constraints, which have worsened due to the COVID-19 pandemic, are also partly to blame. I'm going to go into FX. On the 20th of March, the CBN adjusted the official rate from 307 Naira to 361 Naira per USD and guided the INE, or what we call NAFEX rate, downwards to 380 Naira too. In early July, it adjusted the official rate a second time. In April, the authorities pledged to move towards unification of its rates and towards a more market-determined FX regime. This pledge was made to the IMF, but was not a formal condition attached to the $3.4 billion facility, which was given by the IMF to tackle the COVID-19 pandemic here in Nigeria. Now, unification is far less of a sensitive issue now that the FGN and, of course, NMPC have seemingly abandoned the fuel subsidy. In our view, there has been little change in the CBN's preferences. It had to act in the absence of an alternative, and the trigger was yet again a crashing oil price. So through to the end of next year, we think that it will make small adjustments to contain the pressure, resorting to administrative measures if need be. Next indicator is the monetary policy rate. Now, at its latest meeting, the MPC gave local markets their second shock of the year by cutting the policy rate by 100 basis points to 11.5% on a majority vote of 6-4. The easing can be seen as a textbook response for the committee because it insists that the uptick in headline inflation for 12 successive months is the consequence of legacy structural factors, including inadequate infrastructure, insecurity, rising energy prices due in part to the removal of subsidies, adverse weather, and exchange rate depreciation. If the factors are all structural, it follows that monetary policy is not the perfect solution. The committee's expectation is that deposit money banks respond by continuing to increase their loan books and by lowering their rates for borrowers. We must note that DMBs, that's deposit money banks, have not always passed on policy rate cuts to their customers. The rate cuts in May, for example, did not have this effect. So I'm going to go straight into projections. I'll breeze quickly through projections. So for GDP, our expectation is a contraction of -3% year on year this year. And then we see a modest recovery, or shall I say flattish at 0.1% in the first quarter of next year. And then by end of next year, we see it expanding by just 1.9% year on year, hence returning to its pre-COVID level. The recession this year will be smaller than in advanced and many peer economies because of the limits to Nigeria's integration within the global economy. The limits to its integration within the global village have given Nigeria some protection. So for the same reason, a U-shaped recovery in 2021 is likely to disappoint. Household demand remains squeezed, and I must emphasize that this was the case even before the COVID-19 pandemic. As for inflation, we see it accelerating to 13.7% year on year this year. The headline rates would have reflected squeezed demand and fallen more rapidly had it not been for many supply side constraints, such as power shortages, poor roads, food insecurity, land border closure, etc. These pressures have picked up this year as a result of the lockdown and disruption of supply chains. As for the MPR, we see the policy rate at 11.5%. I believe the final meeting for the year will be happening next week. And then we see it at 11% next year. The MPC trimmed the policy rate. The pass-through effects to the real economy from the policy rate is limited, as I said earlier. The MPC is aware that in Nigeria, the policy response to the virus should not just be monetary. Rather, it should be a combination of fiscal, underpinned by multilateral support, and new lending to preferred sectors, which we've seen them do. As for Bonny Light crude price, we see it at an average of $45 per barrel this year. In our view, the greater hit for the oil sector is now seen in Q3, given Nigeria's failure to meet its OPEC production quota and the FGN's pledge to make good its shortcoming with larger cuts in August and September. Yeah. So this should be reflected in the Q3 national accounts due for release this month. Official reserves, we assume that the FGN will secure the full COVID-19 relief funds from multilaterals that it has sought. Our forecast for reserves is $34 billion in 2020, and this allows for any pipeline of delayed external payments increase. The exchange rate. Well, I've mentioned this already, but I'll repeat myself. We see little change in the CBN's mindset. Our message is unchanged. Any move by the CBN towards market-determined FX rates will be somewhat bumpy. Its preference, evidenced 3 times already this year, is to deploy administrative measures when possible and make small FX adjustments in the absence of any alternative. The oil price recovery has given the CBN a little breathing space, and external concessional loans will also help in some way to shore up reserves as foreign portfolio investors make and plan their exits. I feel the need to just run through trade I just want to touch upon trade. The latest.
That'll be very quick because of time.
Yeah, I'll be very quick. Yes. So
Yeah,
the latest report. I'll be quick. The latest report from the Bureau of Statistics shows that total value of trade came in at 6.2 trillion naira in the second quarter of the year. And this represents a decline of 27% when we compare it to the preceding quarter. And then when we compare with Q1, the total export value decreased by 46% Q on Q. The net result was a deficit of 1.8 trillion naira, which followed a deficit of 420 billion naira in the previous quarter. This makes 3 consecutive trade deficits. Now, the sharp decline seen in the total value of trade mirrors the disruptions caused by COVID-19, given the varying degrees of restrictions with respect to international trade, travel, and tourism. Trade activity across countries is yet to fully pick up. The pandemic has brought into sharp focus Nigeria's weak productive base. Only a small fraction of goods, mainly agricultural products, undergo initial stages of industrial transformation before being exported, severely diminishing their value added. Policymakers need to design structural reforms to revive Nigeria's productive base and increase its industrial self-reliance. Now, the importance of trade in economic development cannot be overemphasized. Trade influences economic growth, employment, and balance of payments. It is therefore pertinent that in order to attain economic resilience and reap the benefits of globalization, an economy must promote exportation, create an enabling environment for exports, and effectively leverage its comparative advantages. So it is imperative that the authorities focus on these 3 pillars to boost trade activities. The subnational government must play an active role in implementing trade policies and facilitating trade. This also implies facilitating value addition and vertical integration within the agricultural value chains. The facilitation of trade in states should also include the training of traders on trade practices to enhance capacity in trade. Another thing to highlight with regards to enabling trade is seaport infrastructure, which is in deplorable state due to a poor maintenance culture here in Nigeria. The major point of exit in Nigeria is, I think, the Apapa seaport, which is in Lagos, and it's notorious for its severe gridlock. Well, I'm going to stop here since I'm out of time. People are asking about my presentation. I will make that available.
Thank you, Chinwe. Thank you for your presentation, which touched on, as expected, some of the fundamentals as well, GDP. I noted the unkept promises of foreign exchange system. I guess everyone is hopeful that the right decisions will be taken, as you spoke to. I noted the transmission of monetary policy, which you also covered about banks and how effective they're able to pass on policy rates. We all know what's going on in the banking industry at the moment. You touched on interest rates, which are at interesting levels. I was fascinated by the projections. You spoke to the recession, which you think is not as bad as it should have. Is not as bad as one would have thought, due to the limited integration with other economies. Some people may argue on that. I think you also spoke to crude oil and where you see the price. You talked on the central bank's mindset as well. You talked on foreign portfolio investors and the Nigerian infrastructure, and all these things, of course, add up to the economy and how quickly the economy can grow. So thank you for your presentation. Unfortunately, the audience, maybe they couldn't get a picture, the video, because the video wasn't on, but I'm sure they can Google it anyway. But I think the voice would have compensated them. Thank you very much. As promised, we will take a break. I've seen some of the questions already. There are about 7 questions, so we'll probably be able to still finish on time. So we will go on break we'll take a break for about 2 minutes. And when we come back, we'll start with the Q&A. Thank you very much.
Access to capital is the lifeblood of every business, and access to a reliable, secure, and efficient platform to facilitate capital raising, transfer of value, and management of risks is even better. FMDQ Group is the one-stop platform in Africa where you can efficiently commence and end all your financial market transactions. From trading, listing and quotation of debt securities such as bonds, commercial papers, to risk management, central counterparty services and settlement, as well as depository of financial market transactions. FMDQ Group empowers and provides corporates, individuals, and government with an unrivaled access to a value chain of opportunities to raise their corporate profiles in the Nigerian financial market. As we work together to create value for your businesses and the Nigerian economy, FMDQ Group, through FMDQ Private Markets, provides an organized platform to promote inclusion of private companies in the capital markets. To empower you to take data-driven financial market decisions through FMDQ eMarkets portal, you gain direct and customized access to a world-class information repository for the fixed income, currencies, and derivatives markets. Subscribe today for unrivaled market data, information, and analytics. We are Africa's first vertically integrated financial market infrastructure group, and our mission is to empower markets for economic progress towards delivering prosperity. At FMDQ Group, our agenda is to make the Nigerian financial markets globally competitive, operationally excellent, liquid, and diverse. For more information on how we create value for you, visit www.fmdqgroup.com.
Welcome back. Interesting advert from FMDQ Group. And I think of our speakers spoke to the importance of access to capital, especially debt for small companies and also private companies. And I'm pleased that FMDQ has such an offering in organizing the market. We'll now go to the segment for questions and answers, and I think we have about 9. And we should be able to do justice to this in the remaining 20 minutes. Dr. Adedipe and Chinwe, I will serve the questions to you. Dr. Adedipe, you will take the first one, and it speaks to, similarities. The speaker spoke to the similarities identified between Brazil and Nigeria, and I know you also spoke to some pair countries, and it doesn't matter whichever one. But I think the question really is, what sectors would you advise for higher economic growth potential in view of what is going on in the world right
now? Thank you so very much for that. I also looked at the Q&A toolbox. Now, clearly, if you look at our economy on the one hand, and as Coco said, now look at what is happening globally, it is very clear the direction that we should be looking for growth. Now, I singled out 3 particular sectors after looking at the data of our GDP and the growth trajectory of the different sectors of the economy in the first and second quarter of this year. Now, which sectors grew first quarter of this year? Which ones grew second quarter? Because some were growing, some were shrinking, and some remained at par, okay? So now, if you look at the sectors that grew first quarter, we see the likes of agriculture, electricity and air conditioning, water supply and storage, ICT, finance and insurance, real estate, public administration, human health and social services. By the time you get to second quarter and look at which sectors actually also grew in the second quarter, in fact, a few of them grew in the second quarter as compared to the first quarter of this year. So there were some sectors that cut across, which means even after COVID-19 impacted the Nigerian economy, and various sectors of it. Some of them still managed to grow during the second quarter of this year. So which sectors grew across those 2 quarters? And we see there, ICT is one of them, which of course is what is happening all over the world. A lot of businesses have migrated to the digital platform. In fact, what we say now is that for any business to survive and then also thrive post-COVID-19, you must digitize end to end. That's the way we describe it. So that means you need to invest more in technology, and that is what is happening. So ICT is a sector that has a lot of promise for growth in this economy and also for business entities. Then of course, finance and insurance is also there stable. If oftentimes when we analyze that sector vis-a-vis the economy, we put it in a context that finance and insurance generally are actually non-cyclical. Because most businesses are either cyclical or counter-cyclical. But they are not cyclical in the sense that finance in the contemporary times hardly goes all the way down when the economy goes in recession. And when the economy is booming up, it doesn't go all the way up. So the cyclicality we see in most sectors don't have finance and insurance. So, and of course, human health for those reasons. Thank you very much.
Thank you very much. I'll pose the next question to Chinwe. In relation to the rising debt profile, the country's rising debt profile, which affects its foreign reserve and other sectors, what are the urgent policies government should undertake to put this in check? Chinwe, are you there?
Can you repeat the question?
Yeah, it's an interesting question. So you're going to just, in relation to Nigeria's rising debt profile, which affects its foreign reserve and other sectors. So let's just call it a rising debt profile. What are the urgent policies government should undertake to put the rising debt profile in check? If you can take that in 1-2 minutes.
Okay, I think I'll give a nutshell answer. For me, I would say policies that would towards boosting revenue. So as opposed to us depending solely on oil receipts and of course hot money from FPIs. So policies that would point towards infrastructural development, particularly looking into the power sector. I guess the power sector is really one of the things that are hindering the well-needed industrial takeoff that would now permit, let's say, SMEs or businesses to plug into boosting non-oil export segments, which would help in contributing to reserves if we have revenue coming in from non-oil export receipts. So that's my 1-minute answer. If I have more time, I can keep talking, but that's my 1-minute answer.
Yeah, thank you, Chinwe. Unfortunately, we have to land this by 1:30, so I think that will suffice. Another question which I find interesting is kindly provide perspectives on top 3 fiscal and monetary policy actions you believe will potentially make most positive impact. And I'm going to ask you, Chinwe, and I'm going to ask Dr. Adedipe this question as well. What do you consider to be the top 3 policy actions that must be taken? And those policies must be fiscal and monetary. So you can give 2 to monetary or 1, whatever you want. Chinwe, I think you should go first before I ask Dr. Adedipe the same question.
Okay, for fiscal, again, for me, I would say, trimming expenses, the budget, so trimming expenses and targeting expenses towards critical, what we call priority. So for me, that's what I would say. We've seen some interventions already coming in from the fiscal side on the back of the COVID-19 pandemic. We've seen that. On the monetary policy side, I am of the view that trimming is the right way to go for now, given what is going on in terms of how depressed the economy is. So, however, as I said in my presentation, that the impact or the penetration of that trimming is very limited. It would be nice to see trimming penetrating properly into the real economy. So I've said 2 now. So a third one. third one, a third one, a third one, a third one.
It can be monetary.
Can monetary, right? Okay. No, I'll go back to fiscal. I'll go back.
That's fine.
Yes. So I think more interventions. I know that. Yeah, I think more interventions. I know that. I'm not trying to say the authorities are not doing enough, but when you look at the impact, it's really minimal. More interventions. When we look at agriculture, when we look at the national accounts, and we look at the GDP structure, the interventions we see in the agriculture sector do not really align with the output that the growth.
Thank you.
So,
thank you.
So I would say more interventions that are better structured.
Okay. Thank you. We're running out of time. Dr. Adedipe, I'd like to serve the same question.
Okay, it's very straightforward, and like Chinwe said, on the fiscal side, the textbook solution to dealing with economic recession is for fiscal expansion, and that is we need to spend, but of course spend in a wise manner, and that is on infrastructure that supports production and of course job creation. The monetary policy is a contentious one, but I would say this is a time it needs to be accommodative. Accommodative monetary policy means that you make credit cheap, all right? And again, it's in line with the fact that we want the economy to grow. So economic monetary policy, we align with expectation of growth. The third one is commercial policy. We deal with the likes of import duty, export duty, and the rest of them, okay? Now, those ones should be designed in such a way that they encourage local production rather than importation of finished goods and services. From those three planks, everything looks in the same direction, and that is to produce more locally here and then be able to deal with most of our urgent challenges economically.
Thank you very much, Dr. Adedipe. I think we have time for one or two more, depending on the time you spend on this. Treasury bills rates are now negative. The person asking this question thinks other investment, I guess fixed income rates will likely follow suit, and is asking, as apart from equities, what are the options? What should happen? Inflation is at 14%. Dr. Adedipe, do you want to start this time?
Okay, I think putting this in perspective, the first question to ask is, what is the nature of treasury bills? Okay, now these are instruments that are safe, are also liquid. So ordinarily, in the primordial risk return relationship, the rate on the treasury bill should be low. That's the, let me say, textbook stuff. Okay, when it comes to practice, there are many other things you are now balancing against that. So the issue also, and this is a global phenomenon, not just in Nigeria, there's always the interplay between the money market and the capital market. Anytime rates are not attractive in the money market, investors usually troop to the capital market. So when you now get to the capital market, you now look at the instruments there. What are the options in terms of near-term, long-term instrument? So it's an ongoing thing, a review of the market and taking position as you interpret the dynamics. So I will say here that there is no textbook solution that says this is where you must hang in permanently. The dynamics of the market will tell you what to do, and then bearing in mind the direction of policy as well. So that's what I will say.
Thank you. Chinwe, thank you, Dr. Adedipe. But Chinwe, do you have a different perspective, or we can, or you aligned?
I'll just add that I consistently would say to people to diversify their portfolio as opposed to just focusing on just one thing. So I'll just add, that's what I would like to add. And then perhaps also considering US denominated investment vehicles or US stocks, you know, that's something to consider as well.
Okay, thank you very much. What I always try to do is to save time and align and land the plane when we should. We've taken one extra minute. I don't think we'll be able to take all the questions via this medium any longer. I guess we'll respond to others, and some of them could still be filed with the Secretariat in NBCC. On this note, I'll thank the audience for listening to the presentations and also for the Q&A session, which I enjoyed. and I hope the presentations will also be shared with those that are interested in it. At this point, I'll call on our friend Alan Alan Davis to do the vote of thanks. Thank you very much, everybody. Have a good day.
Thank you very much. Thank you. Distinguished ladies and gentlemen, it's my pleasure to give the vote of thanks. And we've been very fortunate this afternoon in hearing extremely insightful presentations from our highly respected team of experienced financial gurus. They didn't disappoint us. I thank firstly, therefore, our speakers, Dr. Biodun Adedipe, Ms. Chinwe Egwim, and Mr. Bola Onadele Koko, who was also a very competent moderator. Secondly, we wish to thank our executive partner, the FNDQ Group, for their generous support and sponsorship. Thirdly, we thank the NBCC Programs Committee and the Secretariat for putting this event together. We also thank our council members for their support. And finally, and perhaps most importantly, we thank our attendees. And without you, we would not be having an event. Thank you for joining us. If you're not a member yet of the NBCC, but are interested in becoming a member, please contact Osereme, whose details are being displayed on the screen at the moment. And finally, please follow us on social media to be informed of all our activities. Two of our upcoming events include the NBCC Agri-Food Conference and Exhibition next Thursday, November the 26th at 1 p.m. and the 2020 Presidential Dinner and Awards Ceremony on Friday, December the 4th at 6 p.m. Thank you one and all, and please have a great week.